Okay, in chapter 5, we're going to discuss again talking about agency and some thoughts, some actions that managers take, that owners take, that ultimately have an impact on the value of the company. So let's talk about a concept called management entrenchment. This essentially comes from the separation of ownership and control between managers, right? So managers might make decisions that benefit themselves at investors' expenses. So entrenchment is going to allow management to run the company in their own best interests, right? So we've talked about this a little before. That really is kind of the definition of agency costs. Now, one advantage of using leverage is it allows the original owners, though, to maintain their equity stake, right? So, again, if I don't have to split the company, if I don't have to give up control, that I would rather do that if I'm an original owner, maybe. So let's think about what happens. So Ross is the owner of this company, right? He owns 100 companies. There's no debt, right? If he issues stock, right, he's going to need to sell about 40% of the company to raise the necessary funding that he needs. So the value of the company depends largely on Ross's personal effort. By financing expansion with debt, he's going to keep 100% ownership of the company. So he's going to work harder, and in the end, the company will probably be worth more because he's going to receive 100% of the increase in the firm value. However, if he sells some new shares, he's only going to retain 60% ownership. He's only going to receive 60% of the increase in the firm value. So what should Ross do, right? With leverage, Ross retains 100% ownership, and any perks that he gets, he's going to have to pay full price. But by selling equity, he's only going to have to pay 60% of the cost. So with equity financing, it's more likely that Ross is going to overspend on these luxuries, right? So think about this, right? If the original owner, right, if everything about this company is about them, and then they issue stock, they're now reducing their overall control of the company. Now, this is going to ultimately have an impact that maybe, since they don't have to pay full price for any of their benefits anymore, they may splurge a little bit. They may buy more stuff. So if you issue new equity, we're going to incur some agency costs. And again, as shown in previous, right, if securities are fairly priced, the original owners of the company are going to pay these costs. So using leverage can benefit the firm by preserving ownership concentration and avoiding these extra agency costs. Another concern we might have is what's referred to as wasteful investment, right? What would motivate managers to make negative net present value investments? Why might they want to do that? Well, managers might engage in something called empire building. They prefer to run bigger companies than smaller ones. In fact, research has shown that there's higher salaries for larger companies than small companies. So managers might expand some unprofitable divisions, pay maybe too much for acquisitions, etc. They may do this ultimately to increase their paychecks, increase, in quotes, their empire. So they're overestimating, again, maybe because they're just overconfident. So even when managers attempt to act in shareholders' interest, they might make mistakes, right? And managers tend to be bullish on the company's prospects, and they may believe that new opportunities are there when maybe they're better than they actually are. So in the end, what we're essentially saying here is that it's possible that even if managers are buying good things, they could overinvest, buy either bad projects that we don't need, or just overinvest the company in general because they are overestimating the value of the company, the projects, maybe overestimating their own skill sets. All of these things could be things that could eventually reduce the overall value of the company. We have a concept of something called free cash flow hypothesis. And we may have talked about this in some of our classes, but this is the general idea that says, look, what do companies do that have lots of cash, right? How do managers manage? Or is there a difference between the actions that managers take in high cash companies compared to low cash companies? So if cash is tight, managers are going to be motivated to run the company more efficiently, right? So according to this free cash flow hypothesis, leverage increases value because it commits the firm to future payments, reducing cash flows and potential wasteful spending by managers. So if leverage can reduce the degree of management entrenchment, managers are more likely to be fired, right, if something goes wrong. Managers who are less entrenched are more concerned about their performance and less likely to engage in wasteful investment, right? So again, the idea here is if we have lots of free cash flow, managers are likely to overspend. If we encourage or take on debt, one of the issues that might be true, since now we have contractual obligations, now there will be less free cash flow for managers to potentially misuse. So now let's kind of hopefully bring this all together, right? Companies with greater leverage might become more competitive. They may act more aggressively in protecting their markets because it can't take on the chance of bankruptcy. Leverage might tie managers' hands and commit them to pursue certain strategies with greater vigor, right? So in the end, the leverage itself might encourage managers to work with greater sense of urgency, right? Being more conservative with some of their decisions and maybe more conservative with strategic issues and more aggressive with protection types of issues. So in the end, what we have is we've just expanded our formula of the trade-off model. The value of a levered company, value of the unlevered. You add the tax shield. You subtract out the present value distress costs. We subtract out any negative. We take out the agency costs of debt. And then we add back the agency benefits of debt. So again, we end up with this curvilinear function that shows what happens to value of the company. Now what you see is the difference is with, again, this blue line represents just the company with taxes, right, to maximize debt. What we find out is because of these leverage costs, the agency costs, there could be some positions where the value of the company would be greater than the corporate tax model because the benefits, the the agency benefits of debt are greater than the agency costs of debt, and that provides extra value at the low end. In the end, though, we ultimately have an optimal amount of debt that represents how much we should ultimately borrow to maximize the value of the company. That's not to say, though, that this is the same picture for every single industry, every single company. Research and development intensive companies are going to tend to have much lower debt levels. They tend to have less current free cash flows, and they have risky business strategies. So they're not going to engage in lots of borrowing. However, if you have low growth, mature firms, they're going to ultimately have more stable cash flows, and they may be able to take on higher debt levels. So in the end, what we see is this trade-off model implies that there is an optimal capital structure that the company should strive for. In the last of this video, we'll talk more about what debt levels actually look like in real life. On to the next video.